There are only 8 rules to successful investing, according to Stuart Wemyss, my guest on last week's show, and today we're going to continue on with the balance of those rules.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the 4th time he's won a similar award in the last 6 years.
Investing is easy when you know the rules, just like winning the game of Monopoly. Well, that was what my guest in last week's show, Stuart Wemyss, said, where he went through the first 8 rules of investing, and the conversation went on so long and so good that I asked him to come back to continue it today, and we're going to go through the next 4 rules. Plus, we're going to have a bit of a chat about how to choose a trusted advisor. So if you're wanting to become financially independent, whether it's through property, through businesses or through shares, you must listen to the rules we're going to share in today's show. So welcome once more to another episode of the Michael Yardney podcast. Now, if you missed last week's show, I really urge you to go back to iTunes, Stitcher, wherever you listen to the show or to the Michael Yardney podcast, and listen to part 1 of the 8 rules to successful investing. Now let's continue on with my conversation with Stuart Wemyss. Okay, last week we had a great chat with Stuart Wemyss, Director of Pro Solutions Private Clients, about the 8 golden rules of wealth creation from his new book, Investopoly. So we're going to continue on the conversation now. Welcome back, Stuart.
Thanks, Michael. Thanks for having me.
Now, last week we had a discussion about the golden rules, and if I could quickly recap those. By the way, if you haven't listened to last week's episode of Michael Yardney podcast, go to either iTunes, Stitcher, or the Michael Yardney podcast and have a listen as Stuart went in great detail through. And he calls them golden rules, but they really are. They're the foundation rules of wealth creation. Rule number 1 was play the long game. Avoid trying to get rich quick, because get rich quick tends to get you poor really quickly as well. Be patient and have delayed gratification. His rule number 2 was know how much income you need and by when. In other words, set goals, because most investors don't set goals, and any road can get you there, but similarly any road can get you lost, and that's not really where you want to go. Stuart's rule number 3 was spend less than you earn and invest the difference regularly. That comes from the Richest Man in Babylon and all those classical texts. There's a lot of power in that, what seems like a simple rule. And rule number 4, we both agree on the concept of the importance of capital growth and building an asset base first, doing things in the right order. If you invest in the wrong order, if you invest for cash flow first, you'll never get a big enough asset base to give you the financial independence your family deserves. Was that a fair assessment, a fair summary of your rules, Stuart?
Couldn't have said it better myself, Michael.
Right. So now we've got a few more. Let's go to rule number 5, Stuart.
Number 5 is set your asset allocation to reduce risk, but maximise returns. So asset allocation is an investor's most important decision, without a doubt. So let me say that again. Asset allocation is the investor's most important decision, because if you believe that we can't control market returns, and I think there's a lot of text out there that's, and certainly I believe that, and Michael, you were just nodding, you believe it. We can't control market returns. So what can we control? We can control where our money is invested. That's what we can control. And then we can think long term, as we talked about previously in the rules. So if we do those 2 things, we can't control market returns, but we're going to think long term. Then we don't really care what's going to happen in the shorter term. And no one in the world has developed a consistent way of modelling or predicting which asset class will perform best in the short run. So we don't know, what over the next 12 to 24 months, whether Australian shares, US shares, Australian property, no one knows, right? And if anyone tells you that they know they're fooling themselves or they're fooling you.
Or if anybody tells you should only invest in shares or only invest in properties, you probably should run very quickly as well. They've got a vested interest.
Exactly right, yeah. So what you want to do is have a mix of assets. And what I'm suggesting in this rule is that you can design a portfolio so you've got a mix of assets, and you want two things. There's two things to consider. Volatility and correlation. So stocks are very volatile. They have volatility about 20%, which means if the average return is 10%, then most of the time your return is either going to be negative 10% or positive 30%, a really wide range. Australian property has a volatility of about 10%. And it's a return about 10%. So you're either going to break even, not make any money, or your return is going to be between 0 and 20%, essentially, far more palatable. And bonds have a volatility of about a third of shares. So if you put all your money into the stock market, you've got a highly volatile asset. Now, if I have $100 and I lose 50%, I'm down to $50. I don't need to make 50% back. I've got to make 100% back.
That's what people forget.
Just to get back to where I am. So the most important thing is consistent return with a low volatility. So if I could develop a strategy that's going to give me 8% return each and every year with very low volatility, that's going to beat anything else that has all the swings and roundabouts. And so the way that you can do that is by investing in assets in different ways. And let me sort of cut to the chase and give you a little bit of an insight to what I sort of talk about in the book. And essentially there's very low correlation between Australian residential property and the share market. So you can invest in those two assets and they could have good years together and they could have bad years. So a negative correlation means that if one asset goes up, the other one goes down. A positive correlation means that they both go up and down together. No correlation means there's no relationship. For property investors, there's a negative correlation with bonds, which makes sense, right?
Yes,
because that's all interest rate driven. Yeah. So when interest rates are higher, that puts pressure on asset values and they don't do so well. So if you're a property investor, you hate shares, and there's lots of people like that out there, then what you should do is have a portfolio of bonds and property. So what I'm saying is maybe go really defensive in your super. If you've got an industry fund, choose a really defensive, which will be more bonds, and then you'll have your property investments outside super. And as an asset class, when interest rates are high, your property won't do so well, but your super will do really well, and conversely. So I sort of talk about how you mix assets and what's the best way to do it. And in the book, I actually give some example portfolios, including property, which is rare. I haven't seen any books or publications that talk about residential Australian property.
Well, interestingly, one of the big differences between you and most financial planners is that you talk about property. We know a lot of financial planners aren't allowed to because of their license, and at Metropole Wealth Advisory, as a financial planning company, we are allowed to, just like you are. And I think that's really important for our listeners to recognise that if they want to get down to this level that you're talking about, you need somebody who's a bit more savvy than the average accountant, not somebody who's just selling you property, but somebody who's got a big picture overview of the various asset classes. You've left one element out, and that's liquidity. Property is not very liquid, and that's one of the reasons it's more stable. But shares are more liquid, and that's part of the reason they're more volatile. So how do you cover the ups and downs of the property market? And I'd be suggesting that you do that partly by having the right finance strategies to see you through.
Yeah, that's perfect, Michael. Exactly right. Building buffers to loans. Instead of repaying loans, put monies in offset accounts, and that way you can really, over time, mitigate the downside of property, which it is illiquid. But if I have a whole bunch of cash sitting in my offset account that I've built up over a number of years, well, I no need to worry about liquidity because I've got at least enough cash there to last me a couple of years, and that's plenty of time to sell an asset if that's what I decide to do.
So the concept really is, rather than paying down your loan, putting your money into an offset account linked to your investment loan, in theory, then you're not paying as much interest because it's offsetting the interest. It's like repaying it, but it's yours to take back if you lose a job, if the property market has a difficult time, if you lose a tenant, if you've got to do a major repair. So part of becoming a successful investor is having the right ownership structures, having the right assets, and you're talking about asset mix now, and having a right finance strategy, because property is really a game of finance with some real estate thrown in the middle. So you need somebody, and that's one of the interesting things that I know you and your firm have got handle on all of those, which is great. So anything further about rule number 5 about your asset selection you want to discuss?
One common concern with people is that property is a lumpy asset, right?
Yes.
So, if I start out investing...
How do I diversify?
How do you diversify? Exactly right. Well, the answer is you can't and you don't. So there's two sort of things that I guess I can say here. Firstly, think about your asset allocation ex property, excluding property. So when you're looking at asset allocation for your super, then just have a look at that by itself. Because it takes a long time to build up diversification because property is a lumpy asset. And as we talked about in rule number 4, previously last week, we talked about growing your asset base, which is investing in capital growth asset, which is sort of property. So you've got to do that first. So kind of ignore asset allocation. What you want is a good asset allocation by the time you get to your goal, which is retirement. That's when you want to achieve a nice diversified level. But because we have to invest in assets in different orders we don't have to, but it's efficient to do so, you're not going to achieve a perfect asset allocation throughout your journey.
Sure. So that concept of diversification leads to averageness, bottom of the best and cream of the crap. I'd rather actually specialise. So I own a lot of investment properties, and in Melbourne, they tend to be in 4 municipalities. I'm not going to suddenly invest in Cranbourne or Point Cook because I've got too many properties in the city of Burundara and the city of Bayside and the higher end ones. I'd rather put all my nest eggs in a basket and watch them very carefully. So it also means that you've got to understand what your assets, how your assets would perform, and have those financial buffers and other risk mitigation structures in place.
Exactly right. I mean, diversification's good, but I wouldn't do it at the cost of actually reducing my investment methodology or philosophy or strategy. And at the end of the day, quality trumps everything.
So actually, before I go on to what I was about to say, I remember it so well from one of your blogs probably 10 years ago. The very clever words where you said if you can only own 3 or 4 properties, just make sure you own the best 3 or 4 you can rather than having a large quantity. So you've got to make sure that your assets are working hard for you. So rule number 5 from Investopoly is set your asset allocations to reduce your risks and maximise your return. As you said, a very important rule. Rule number 6 now, Stuart.
Number 6 is all about investing in shares. And I believe that you need to invest in shares using a low-cost passive methodology. And so this is really important. And whilst you might not be interested in shares, certainly your super is probably invested in the share market. Yep. So you should certainly understand this. So there's 2 types of asset management typically. So that is asset management, how people invest in shares, active and passive. So active is all about a super fund or a managed fund provider coming in telling you a bit of a marketing story, which is you give me your money, you pay me a fee, and I'll buy and sell and pick the stocks that I think are going to be worthwhile to invest in, and I think I can beat the market. And when I say the market, the index, so in Australia, the common index is ASX 200, the top 200 companies by value, and that's really the quasi measure for the market. The problem is that there's a huge and growing body of evidence that suggests that very few fund managers can beat the market, or virtually none, maybe around 4% based on some research, beat the market consistently over the long term. So you find some fund managers might have a great year and then even maybe have 2 good years in a row, but then the third is terrible and so forth. So it's a little bit like picking a needle in a haystack, because if you're going to use active funds management, you've got to find which super fund or which fund manager is going to beat the market this year, and then you've got to know when to jump off the bandwagon and then how to find the next one. So again, it's a little bit like picking a needle in a haystack. You're better off just to invest in the haystack, which is really the index, the market. So there's a few advantages of using indexing. The first one is that the fees are really low. They're somewhere between 5 and 20 times lower than what you'd pay an active fund manager. So that reduces your risk, right? Because if you're going to pay me $100 and I'm going to promise you returns of something in excess of $100, you've then got to be really confident I can make you $100. But if you pay me $1, your risk is a lot lower because I've only got to make $1 for you to be better off. So reducing your fees. The second thing is that index funds use a rules evidence-based approach. That is, you're not paying some clown in an office to spin the wheel and work out which share to invest in. You're using it as a rules-based approach. And that's why it's so low cost, and rules-based approaches are repeatable. You don't need someone to come up with a new idea and those sorts of things. And lastly, there's a few different index methodologies that you can utilize. Market cap is a traditional index in which you'd invest in the proportions to which companies make up a market capitalisation. So, for example, CBA makes up about 8% of the index. So 8% of our money goes into CBA and vice versa. But there's a few different methodologies to employ there.
So this is really investing rather than speculating, because the way a lot of people think they're investing in the share market's speculating.
Exactly
the
right.
Next Facebook, looking for the next Google.
And it never works, Michael. I've been doing this for 15 years. Typically what I see when someone comes into my office with a share portfolio is that they'll have less than 20 stocks. Well, statistically, to diversify away from unsystematic risk, you need more than 20 stocks, a lot more. So that's the first error. Most of their portfolio would be in losses. And the rare investor that actually is ahead, all their profit is in one or two different companies, and the other 18 are in losses, right? So it shows that it's just random. And Bernard Melke, who started Vanguard in the 70s, which was the first index money manager, and it's the largest, and it's not for profit. It's a great business. Wrote a book called Random Walk Down Wall Street, which is a best-selling book, fantastic book, essentially saying returns are random, right? So who can pick it? No one can pick it. And so it depends on the research that you look at, and again, there's lots of information on the web about this, but somewhere between 70 and 96% of active fund managers fail to beat the market. The longer the research period, so 96 was a 15-year research period, 70% was a 5-year research period. So the longer the period, the fewer they do it. So,
interesting.
So why do it?
You need an element of shares, but don't try and beat the market. Have an index fund.
Go index low cost.
Golden rule number 7. I've had a sneak peek at it, and it's one I love.
It's right up your alley. Only invest in investment-grade property. So let me first say, I guess, quite often people seem obsessed with the question of how many properties do I need? How many properties should I buy? All that, it's always about a number. And frankly, it's a kind of a meaningless target because quality trumps quantity every single day of the week. Let me tell you, I would much prefer to own the best property in Melbourne than 10 average properties all over Australia or in Melbourne, doesn't matter where they are. So it's all about investing in the right assets. And for shares, as we just talked about, asset selection isn't that important. Methodology is the most important thing. For property, asset selection is I believe 90% of your returns will come from your ability to select the right asset. Yes. That's the thing that you need to nail, right? So what is investment grade property? Well, in my view, investment grade property is property that will double every 7 to 12 years. And I appreciate that's a lot. That's quite a wide range, but it's going to depend on the quality of the property. Every 7 to 12 years, compounding annually, consistently, perpetually. So we'll keep doing that. Won't do it for probably 100 years, but we'll certainly do it for our lifetime. I believe there's 3 things that need to be present. And I guess if people apply not only these rules in Investopoly to their past decisions, where they've made mistakes, it'll highlight where the mistakes have been. And if they apply these 3 rules to their property assets, it might also highlight either the things that they've done right or done wrong.
Let's just, before you move on to those rules, explain that any property can become an investment property. You just kick out the landlord, put a tenant in, and it becomes an investment. But that's different from what you're saying. Investment grade is something that's going to outperform the averages and grow at wealth-producing rates of return. And you're going to do that with 3 factors. So let's go through those.
I'll jump into those, but you make a really good point, Michael, because if you believe what a lot of the world's economists are saying, that asset growth in the next 30 years won't be what it was in the last 30 years, and mostly maybe because of systemic changes in the underlying economy and the absence of much lower inflationary environment. So in a rising tide, all ships rise, right? So in the last 30 years, been rising tide, all ships have risen. If the economists are correct, and there's a lot of data and stuff out there that suggests they are, then asset selection in the next 30 years will become even more important than it was the last 30 years. So the three things that you need is a really strong land value component. So more than 50% of the overall value of the property needs to be land, or putting it differently, the building value needs to be less than 50% of the overall value.
Now, that doesn't mean it has to be land or a house with land in front and back. I'd rather own under a 6-star block of good apartments in one of the inner ring suburbs of Melbourne, Sydney, rather than a whole farm acreage out in the outer suburbs. But fully agree with you, a high land to asset ratio is important.
Absolutely, and of course, apartments, and particularly older style apartments, have an
old flats, not the new apartments.
Correct, have an attributable land value. So don't discount units. Definitely don't discount units. In fact, I think
we're buying here in Melbourne, where the apartments are a little bit quieter. We're buying the old villa units or townhouses. So people are trading their backyards for courtyards and balconies, and there's way more of us are going to live. So no issue with it. But not a block where there's 200, where the land to asset ratio is the wrong way around.
Yeah. You might have 5% land value in that situation. It's just not going to work because it's just not land appreciates, building depreciates. So you need more land to offset the building depreciation. So the second one is scarcity. You want scarcity in terms of land supply and property style and type. So land supply in terms of you want to invest in areas where the supply is very tight, and in fact, quite often in a lot of these investment grade suburbs, there is no land supply. There's no vacant land.
They're the NIMBY areas where, not in my backyard, you can do the development in the next suburb, but not in the sort of suburbs that you and I live in where the locals don't want it.
No, exactly right. And you don't want to invest in a new supply area, for example, a new build area where there's land supply is abundant. The laws of supply and demand are going to work against you. And then in terms of property type and location, so scarcity, that means that everyone wants to live in that location because the amenities in that area and the architectural style is timeless and all these sorts of things.
And not just tenants. The people who want to live there are also owner-occupiers. Not that you're going to sell, but they're going to buy similar properties around you, pushing up the value of yours.
Exactly right. And the last thing is proven performance. We're not gambling here, people. We're investing. And investing is all about achieving the highest return for lowest risk. So why would you invest in an asset if it hasn't proven its ability to generate capital growth? You just don't need to take that risk. So
it's one of the problems with the new and off the plan developments too. You really don't see what that development's going to do, like what sort of people are going to be living there, what the mix of owner-occupier and tenants are for quite some time.
The price is struck by the development cost plus the development profit, and that's the price we need to. And marketing costs, exactly right. So off the plan, a new build property fails all three of these rules, and that's why they just don't work. So you want to be able to have a look at what has the property been bought and sold for over the last 30 years or 20 or 30 years, and hopefully there's been a few transactions. And what you can then do is mathematically work out what's the growth rate. And then what you can do is spread your cast your net a little bit wider and have a look at what the properties next door and across the road, and it starts to build a story, right? And quite often, now property's part art and part science, so we can't get too analytical or over analytical about property. You need both, and they're both very complementary. But this part of it is really looking at what is the story, the past growth story telling us.
Now, there's a combination there, as you say, because some of this information you can get off the internet, you can get the reports, but there's another element that you just can't get, and that's perspective, that's experience, that's on-the-ground knowledge of what's going on. A lot of investors buy 3-4 properties, most only ever buy 1 or 2 in their lifestyle time, and that's why you probably need somebody on your side to help you.
Exactly right. And you'll certainly love what I'm going to say next, Michael, which is, and I say this as completely independent without any vested interest in saying this, but if you're going to pay for any advice in your investment journey, it's asset selection advice, because that's the key here with property, buying the right property. So finding a reputable buyer's agent that's been in the market for many years, that has runs on the board that you can trust and you feel comfortable with, and having them advise you on the asset selection and keep out of it. Keep your own personal tastes and preferences and opinion. What you're trying to do is you're paying a lot of money for this person to buy you the right asset. So don't ruin the value of that advice with your own likes or dislikes. You don't need to like the property, you just need to like the returns.
That makes sense. So we also discussed a bit earlier in the chat that you don't need that many assets. It's not how many you have, it's the quality of them. And I say something very similar to what you said before. I'd rather own one Westfield shopping centre than 50 properties in regional Australia. So, okay, most of us will never own a Westfield shopping centre, but the quality really relates to what's going to be in continuous strong demand in the future by a wide range of owner-occupiers, but actually the more affluent ones, the ones who can afford to and are going to be prepared to push up the value of those. So demographics and how people are going to want to live, where they're going to want to live, is going to make a big difference to what's going to be popular in the long term.
So sometimes I listen to other people's podcasts or read stuff around the place and people intimating they might need maybe 5 or 6 or 7 investment properties. And I sort of scratch my head because as a financial planner, independent financial planner, I've been doing this for 15 years. It would be very rare where I would recommend more than 3 properties, because then you've got problems with how debt exit management strategies, liquidity, like we talked about, diversifying in terms of asset allocation. So for most people, I think the answer is somewhere between 0 or 1 and 3, not 0, 1 and 3. But you don't have to amass this massive property portfolio. Quality trumps quantity.
Well, the tax office statistics tell us how many property investors get more than 3, and apparently there are just under 20,000 taxable units. So that's family trusts, individuals, families, super funds who own 6 or more properties in Australia. Less than 20,000 from the last set of tax statistics. So again, most don't achieve that. But the ones you see on the front of the magazines, you've got 15 properties in mining towns or regional towns, they would skew those statistics badly. Just because they got so many doesn't mean it works.
That's exactly right. So ignore that noise. That's only noise. It's marketing noise to sell magazines and all these sorts of things. So be confident that even if you just have 1 or 2, but really fantastic quality properties. So if I had a budget, for example, of $800,000, would I buy 1 or 2 properties? Without a doubt, I would buy 1 property. That's not enough.
Such a good point, because most people think I'll just split it in 2 because that's going to diversify and hedge my risks. In fact, it doesn't. You buy lesser quality properties, so you're actually not hedging your bets at all.
I met with some clients this morning, and they proposed the exact same thing. I could reduce my risk. They were from northern New South Wales. I could reduce my risk by spending $400,000 where I lived. And I told them straight up, I'd rather stick pins in my eyes. If you're going to go that way, then property's not the answer. We find another asset. If you're not comfortable spending, what I was saying to them in Melbourne, $750,000 to $800,000, if you're not comfortable with that, that's fine. But let's find another asset class.
That's a problem I see with a lot of people from regional Australia, because that would buy them a whole farm. For some of those regional towns, that buy most of the main street. So they find it really hard having an investment that costs twice as much as their home.
Yep. Again, that's why you need asset selection and advice to give you the confidence. And really what you're doing is you're paying, the way I see it, it's like insurance against choosing the wrong asset. Because you choose the wrong asset with property, it's all over.
So you don't only need asset selection advice, you need loan structuring advice, you need a mortgage broker that's savvy, that understands this, that doesn't just get you the loan for this property but has the big picture in mind, and also some risk management and asset protection advice as well, which I believe is golden rule number 8.
Exactly right. So you've got to think about, once you've developed your strategy, which is say, okay, I'm young, so I need to invest in property. I need a couple of really great properties, and then I'll put some money in the offset account to build liquidity, and I'll make super contributions, and that'll be enough to get me to retirement. So that might be a very high level description of your investment strategy. The last step, which is golden rule number 8, is think about all the things that can go wrong. So the best investors just don't take any risk. They take 0 risk for very large return. And you say, well, that's easy for them. They're billionaires. And they are, but that's how they got billionaires, by not taking risks, right? So
you sometimes have to start off by taking a bit of a risk. But one of the trends I've found, like you, with my successful investor clients, is once they get a little bit behind them, they don't speculate. They don't risk. But, Stuart, that's boring, and people are looking for excitement. I say, go bungee jumping, go trail bike riding. Don't look for excitement in this.
Yeah, go to the football. But what I'm talking about reducing risk is, for example, income protection insurance is a really, and I'm not going to sit here espousing the benefits or trying to oversell insurance or anything like that. But essentially, if you're a property investor, you have to make friends with the fact that you've got to borrow. You probably have to borrow at relatively high levels, and you've probably got to do that for a reasonable amount of time. It's also, those borrowings are probably premised on the idea that you're going to have to get out of bed and go to work every morning, and you're probably going to have to do that for another 10 to 20 possible years. So one of your key risks then is having a car accident. If you have a car accident, which we all could be subject to, except for me, I'm an incredibly good driver, which my wife keeps telling me. If you're going to have a car accident and you can't work for the next 7 years, what's that going to do financially? It's going to, you probably will never recover financially from such an event. Maybe medically you can, putting that aside. So go get yourself some income protection insurance. It'll cost you a couple of grand a year, maybe. Maybe it's a lot cheaper. But it's the cost of investing. But this is the thing that I think, Michael...
It's the cost of doing business. If you had a shop, you'd be insuring the stock and you'd be insuring other things. This is a business. You've got to treat it that way. You insure the buildings, but you're not insuring the biggest asset you've got.
Exactly right. And I don't think they're divisible decisions. If I'm going to be a property investor, I'm going to borrow, I want to protect my income. That just makes common sense, but I'm protecting my family and those sorts of things. So, look, there's some research done by ASIC, I think last year or the year before, and it was pretty damning about the sort of advice that insurance advisors are providing, that they get a client and they just try and sell as much as insurance as possible. So be wary about that. And you don't need massive amounts of insurance, but none is not the right answer either. It's not a black or white decision. It's really about how much is right for your position.
So we're talking about protecting your assets now. So we've first talked about growing them. Now we're talking about protecting them so you're not getting leakage. One is in assuring yourself for income protection and life insurance.
Yep.
What about protecting the risk of interest rates? They're going to go up, they're going to go down. What do I do?
So quite often people sit there and think about, well, should I go fixed or variable? What's the fixed rate? Compare it to the current variable rate, and then I'll make a decision. And if the fixed rate's lower than the variable rate, the decision's pretty easy. And if it's a lot higher than the variable rate, people think it's no good. But that's not really the reason. We're not playing the interest rate market here, are we? We're not trying to predict what interest rates will do and whether I'll be better off or not better off. What we're really trying to think about, or what we should be trying to think about, is how sensitive is my cash flow to interest rate movements? If my cash flow is not sensitive, then ride the wave, ride the volatility, go variable. If your cash flow is sensitive to interest rates, lock it in and stagger your interest rates. Lock in some for 5 years, some for 3 years. I'd caution anyone fixing longer than 5 years. Typically, that doesn't make a lot of sense in terms of interest rate product and strategy. But stagger the interest rates and just manage your exposure.
Well, I've realised over the years how important that is, because I got caught out in the early 90s when interest rates went up very, very high. Fortunately, I got through it, but I saw some of my friends get into trouble with the banks, and so it's made me a much more cautious investor. I've also realised every time I fix, interest rates go the other way, but I don't fix to beat the banks. I do it to steady my cash flow. So I have got things at 1, 2, 3, 4 and 5 year interest rates, and I agree with you, I haven't gone longer than that. And I've chosen not to make them all come to term at the same time, because I don't know what interest rates are going to be. No one really knows in the future. So it's really just a risk mitigation strategy. And I keep a portion fixed, a portion floating, variable. So I've got the opportunity to take advantage of the opportunities that may come up. So we talked about interest rates fixing. And by the way, even if you have one loan, you can fix a portion of it, can't you?
Yeah, of course. Yeah.
So that's another risk mitigation strategy. We've also, there's landlord insurance, another form of insurance we didn't talk about before. But there's another topic people don't like thinking about. One is what happens when they die, estate planning, and the other is, what happens if your marriage breaks down? And unfortunately, the statistics suggest that a high percentage of people listening to this podcast, unfortunately, will go through a marital breakup. So how do you protect yourself against those eventualities?
And that's it. It's a statistical risk, and I think then it warrants some sort of consideration. It's a very difficult topic sometimes to bring up, and some people are interested in having a conversation around protecting themselves, and some people are not. So that's going to very much dictate your circumstances. But I guess there's two asset protection considerations here. The first one is that if you're young and you're just going out with someone, you've got a boyfriend or girlfriend, just understanding at what point will that relationship start to look like a de facto relationship as opposed to two single individual people. And there's nothing, no hard and fast rules, but cohabitating longer than 6 months, sharing of finances, sharing of chores, jobs at home, these sorts of things. It all goes into the mix that the family court will look at. So think about if you're going to start living with someone or combining finances or buying an investment property together, for example, think about putting some agreements in place just so that everyone understands that what's gone in and what will come out if the relationship doesn't proceed.
So even if you're not married and have what people sometimes call a prenuptial, you can have a cohabitation agreement, because some people have very long relationships without tying that final knot.
Yeah, exactly right. And sometimes people get into relationships and it doesn't work out, and the other person, one of the parties starts acting quite aggressively financially, and they could be dudded out of a lot of money, potentially if they've invested well, it's all undone. So, and then the same with marriages. It's obviously a bit different because people are going eyes wide open, but just think about whether it's
you think you are.
Well, depends on your age, I guess. Yeah, you're right. Just think about whether you want to document something, and it doesn't have to be. I guess prenups get a bit of a dirty word. You've got someone with all the money, someone with no money, and the person with all the money doesn't want to give anything away. Anything can be in the agreement that you want it to. I think it's just about understanding, well, if it doesn't work out, how are we going to go our separate ways?
With estate planning, with wills and power of attorneys, there's also a bigger complication following on from what we've just said. So many people have a blended family. So there are my kids, your kids, our kids, and so estate planning can get very complicated.
Exactly right. And the cheapest advice is professional advice, right? So if you've got a blended family, you definitely need good quality advice. If you're a single person, you just need a really basic will. You can probably just get a basic will. If you're a couple and you're starting to build wealth, you need something that's in between. You don't overcomplicate it, but a basic will from a will kit or something's just not going to do it. The things that you need to start thinking about is guardianship. So if you've got children, you probably, if you've got property assets, want a testamentary trust, and this is beyond the scope of this conversation, but these sorts of things, you want power of attorneys, medical and financial. But they're very easy, simple things to look after, Michael. But I find that I reckon if you force me to come up with a percentage, I reckon 80% of new clients I meet don't have wills.
Yes, and I accept that we're seeing much the same. So we're going through the 8 golden rules of wealth creation from Stuart Wemyss' new book, Investopoly. And Stuart, you offered the listeners of this podcast a special bonus to be able to get a discount for it. Not that they need a discount, because just going through this, it makes so much sense, and it sounds like you put a lot of time and effort into putting some structure to all the information and discussions you've had with clients over the years. But if we can tease some people to buy it and get a special discount, how do they get it?
Yeah, well, I wrote it so people could read it. So the more people that read it, the happier I am. So you just go to investopoly.com.au and you can follow links there. There's a little buy button there. And if you use the coupon code Yardney, I'll give you a 30% discount.
Fantastic. I really appreciate that. Now, just to round all this off, clearly one of the things that came out of this is that investing isn't a solo game. You're silly, you're arrogant if you think you can do better than those people who are professionally doing this all the time. So I've found most of our successful clients have advisors in various areas of their life, and they see them as an investment, not as an expense. And really having good advisors is another risk mitigation strategy, rather than trying to do it on your own. With so many people, some with vested interests, some enthusiastic amateurs, how do you select an advisor you can trust?
Well, if you've already decided you like to invest in property or shares, it's kind of easy. You find the right advisor that's going to help you with that asset class. But if you don't know where to start, what you really need, in my opinion, is an independent financial advisor. Now, with the Royal Commission going on into banking and so forth, there's a lot of noise around greedy planners, bad advice, all that sort of stuff, which I'm not refuting, by the way. I think a lot of the stories are disgusting and terrible, and I think the industry should have been cleaned up years ago. So I totally understand that. But here's the answer, that 99 or probably 100% of all those horror stories that you see on 60 Minutes or read in the paper are a result of conflicted advice.
Mm-hmm.
So you need an independent financial advisor. I think there's 5 things that makes an advisor independent. Firstly, they take no commissions, referral fees or kickbacks. So whether a client...
But I read from the Royal Commission, people are bringing envelopes of cash, and they're not to financial planners, to get mortgages across the line. It's
insane. Mortgage brokers are selling property to their clients, from developers and getting $20,000 or $30,000 of property. It's massive, and the clients don't know. They think they're getting this great asset. It's terrible. So you don't want the advisor to have a vested interest in the advice outcome. So whether you invest in property shares or do nothing, shouldn't be any different. They should charge you a fixed fee. So either an hourly rate or a fixed fee, not a percentage. Percentage of your wealth isn't reflective really the time or the risk involved. They should have nothing to sell you. So certainly our business, of course, we help with mortgages and insurance, but no investments to sell you, whether it's a super fund or a managed fund. And there's some really big businesses out there that have their own managed funds and sell their own managed funds, and I'm not in love with those businesses. Number 4, they should be independently owned. So one of the difficult things, and there's a lot of research around this, that Australians find is to realise the difference between an institutionally owned advisor and a bank-owned advisor. So banks bought a lot of brands. So you might be thinking you're dealing with the independent business, but really they're owned by the banks or or the insurance company like AMP. So you want someone that's completely independently owned. And number 5, they've got to demonstrate knowledge of all the asset classes. So if you walk into a Ford dealership, they're going to tell you Ford's better than Holden. You should buy a Ford. You know that, right? Eyes wide open. What you want is someone that knows equal amounts of Ford and Holden, so then they can really understand your needs and decide which is the right way to go.
And that's the problem, because most financial planners aren't allowed to talk about property, in fact don't know much about it at all.
Exactly right. And so if I'm going to sit in front of a client and say you should invest in property or you should not invest in property, you want to make sure that I've weighed all the options up and I've got some really good reasons of why property suits you and why it doesn't suit you. Now, if you apply the rules, the 8 rules that we've talked through, quite easily, a lot of people should be investing in property. It makes mathematical sense to do that. So that's fine, but understand the right types of property.
So finding an advisor, you've told us what to avoid. I guess you're paying for their experience, aren't you?
Exactly right. What's that saying that most people learn from their own mistakes? Smart people learn from other people's mistakes and dumb people never learn. So I guess it's an opportunity. We've both been doing this for a long period of time. So we've seen the good, the bad and the ugly. And we've made mistakes ourselves along the way without a doubt. And we've seen our clients make mistakes as well, not before we've met them, obviously, not as a result of our advice. So you can learn from all that, all those experiences. So knowledge is one thing, but experience tells you how to apply that knowledge. And that's absolutely key. So, you can go and study everything that I know, but then how do you then implement that knowledge? That's what experience tells you.
That comes from time, from perspective, from years. And that's why you can have all these enthusiastic amateurs now giving advice about property, about finance, about mortgages, but that's not the way to go. You need the experience. And I think one of the other things you've got to recognise is you've got to have somebody who's going to tell you what not to do and what's in your best interest, because a lot of people go along to get confirmation of what they've already had set in their mind of which way they want to go.
A really good example that I've come across over the last 15 years is buyer's agents, right? If you get a buyer's agent should sometimes listen to their client, and they sometimes, in my opinion, should not listen to their client. So if I've heard people go off to buyer's agents and said, no, I've done my research, I want to buy a property in this area, and it's clearly not an investment grade location, but the buyer's agent just wants to get the deal done, make the revenue, and so they go and buy that particular property. What you want is someone that's going to turn around and say, you know what? I'm not going to do that because I know that's not going to work.
Sure. Well, buyer's agents in many cases are just order takers, and that's why our model at Metropole is they sit with the property strategist who actually comes from a wealth background. They're coming from banking backgrounds, financial planning backgrounds, accounting backgrounds, economic backgrounds, and fully understand real estate as well. But they actually have that wide knowledge, and it makes no difference to them whether it's Melbourne, Sydney, Brisbane. We don't have any properties for sale. And once a strategy is formulated that takes into account their timeframes, their risk profile, what their needs are, what their budgets are, then the buyer's agent institutes the strategy that's been put together by the strategist. So I fully accept your points. Makes a lot of sense. Stuart, this part of our chat's gone a bit longer than I'd initially planned and longer than the normal Michael Yardney podcast, but I've had so much fun talking about it with you. It's always great catching up with you and about your new book, Investopoly. So I wish you all the best. One more time, if people want to take advantage of the special bonus, how do they get it?
Just go to investopoly.com.au and follow the links and use the code Yardney for a 30% discount. And I hope people enjoy the book. I've certainly put a lot of effort and energy into it. So if they do enjoy it, certainly spread the word.
That'd be great. And of course, I'll have that link in the show notes to this podcast at michaelyardneypodcast.com. Thank you once more, Stuart Wemyss from Pro Solutions Private Clients.
Thanks very much, Michael. It's been fantastic.
Wow, what a jam-packed show. Stuart Wemyss gave us lots of information about how to become a successful property investor. And as you can see, we obviously have some thoughts in common. I hope you got a lot out of it. I really think these are the sort of shows you should listen to a second time. You listen at 1.5 times speed. It makes things go quicker, but you're still going to get all the great information. And I look forward to joining you again in a week's time with the next episode of the Michael Yardney podcast.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You learn some new ideas about property investment, success and money in around 20 minutes.